Hey guys, today we're going to go over the cash flow statement. As you can see, where we are right now with the balance sheet is that we're done with the majority of it, but the only things we have left is our cash and cash equivalents and our debt. We will find a separate debt analysis for this. We don't have to worry about this now, but for cash and cash equivalents, after we're done finding our cash flow statement, kind of figuring out our cash flow statement, we're going to get that amount. So what exactly is a cash flow statement? A cash flow statement is essentially a reconciliation between the income statement and balance sheet. So that means it basically kind of tracks any cash inflows and outflows that happens between the income statement and the balance sheet. That's what exactly the cash flow statement does. So it has three separate segments. It has a cash for operations, from investing, and from financing. And essentially it tracks inflows and outflows from each segment, and then we find a total tax effect, a cash effect, and that's going to be our cash and cash equivalents. So first we're going to link up our net income, which is going to be over here. There. Then we're going to link up our depreciation and amortization, which is going to be over here. Now, why isn't our depreciation negative? Well, first let me start with net income. Net income is going to be a cash inflow, right? This is the money that's coming in. That's why this is a positive number. Depreciation amortization is a non-cash expense. That means we're not really paying any cash out. So what happened is that we said there was a cash outflow when there was no cash outflow to begin with. So we have to add this back in. Changes in working capital. This is our changes in working capital, like we said to our couple videos back. So first we're going to link up. Well, now we're gonna find the changes in our accounts receivables and whatnot, right? And you'll notice that with assets, we take the previous year subtracted by the current year, and the reason we do that is that first is a negative number, and second, yeah, it's a negative number, so that means there's a cash outflow when it comes to assets. But with liabilities, it is a cash inflow, so the money comes inside, so that's going to be a positive number. So with accounts receivables, we're going to take the previous year. We're going to subtract it by the current year. With inventories, we're going to do the same because it is an asset. So, and it is a cash outflow. Okay, deferred income tax, we're going to do the same. And when it means the assets as well, so don't get confused with the one on liabilities. Okay, prepaid expense, we're going to do the same. Other current assets, we're going to accounts payable. Taxes payable. Actually, I messed up somewhere. Hold on. Yeah, accounts payable. This is supposed to be a positive number. And so is this. Okay, why is it a positive? Well, let me explain after I connect these up. The reason this is going to be a positive number is because, like I said, our liabilities is our cash inflows. So it's going to be a positive number. That means cash is coming in, right? So other current liabilities. Deferred tax liabilities. equity and income affiliates. Now this is going to be on our equity side. No, yeah, on our assets, right? So we're gonna subtract our previous year than our current year, right? So we're going to take this year, then we're gonna subtract it by G78 because this is an asset and this is a cash outflow. Okay, so then we have dividends received from affiliates. So this is going to be, alright, so although this is not on our balance sheet, we did project this out, which is going to be over here. Dividends right here. We assume that there will be no dividends, so we're just going to link up 0 right here. And minority interest expense, which is going to be in our equities, we're basically going to take our current year subtracted by our F97. So even with our equity, we take our current year minus our previous year because that is a cash inflow. So our cash from operation is simply just a sum of everything over here. Okay, so purchases of fixed assets, that means our capital expenditures. Now we didn't project this out. Well, we did project this out into our supporting schedules. So if you go up to your PP&E schedule, you're going to find capital expenditures. So we're just going to link that up. Our proceeds from fixed asset sales. So fixed assets, sales of fixed assets. I'm sorry. So we're going to go into our PP&E. Recurring asset sales is 0, so we're going to put 0. Purchase of intangible assets. We go to our schedule over here. Purchase of intangible assets. We have 0. And these are the assumptions that we've made, that there will be no buying or selling of assets since this is a non-recurring activity for the company. Purchases and proceeds from other long-term assets. This is essentially going to be your other non-current assets. So you're going to take your previous year subtracted by your current year. There you go. And cash from investing is a sum of all of that. There. Now, convertible preferred stock. Okay, what we're going to do, we're going to go to our equity side now, and we're going to take our current year subtract our previous year. So if this is going to be a 0. Common stock and APIC is going to be this number subtract by that. And see what happens. You have 227.7. This number is similar to this number, right? Now, why is it the same? Well, that's how we grew our common stock, is by the issuance of stock. Makes sense, right? So being familiar familiarize yourself with these connections, because there's a difference between memorizing the steps in modeling versus knowing what you're doing and what's the implications behind it. So do know the implications behind what you're doing. Treasury stock repurchases. And we're going to see the same thing over here. So we're going to take this year subtracted by our previous year, negative 850. So if you go back to your diluted shares schedule, you're going to find negative 850 right here. So just find those kind of patterns and kind of link them up and kind of make sense out of them. Comprehensive accumulated loss. So we go to our balance sheet, comprehensive, right there, F101. There. Other equity accounts is going to be let me just zoom in actually. So so this is our operations. These are our investing. Cash will be out from investing, and this is our financing. So we're almost done with our financing part. Common and preferred dividends. Where did we find that? Well, we did put them in our income statement, so it's going to be up in our income statement. There. Okay, now in dividends, and this is going to be a negative because we're paying this out, right? So this is going to be a negative. Dividends to minority interest. This is in our minority interest schedule, which is over here. So we have 0 in dividends. and our increase and decrease in debt. And this is going to be essentially the sum of our debt for the current year, which is right now 0, but we're going to figure that out after we figure out our debt, which will be later on. So we're going to take F92, close it there, right? And then we're going to find the sum of our financing cash flows. So we're going to take that and there. So now we can, well actually I can get this done too. So now you can take your cash from operations, plus your cash from investing, plus your cash from financing. I did make a mistake here. This is going to be a negative, and the reason this is going to be a negative is because purchases. We're making a purchase. That means there's a cash outflow. That's why this is going to be a negative. Great, awesome. So now we can just kind of go up, copy, paste. Okay, did not paste at all. There. Just zoom in again. There. Okay, so now we have found our cash and cash equivalents, which is essentially this number plus our increase and decrease in cash. Yeah, sorry about that. Okay, so let me go back to the model. Alright. So we found so we can Control C, copy this all the way down. So we found our cash now. Okay, so we are officially done. Well, we're somewhat done with the cash flow statement. We're still going to mess around with notifying our debt, but we're going to worry about that later on in the video. Alright, well, I'm going to catch you guys later.